but Alok Agarwal is now joining us from Alchemy. Alok, afternoon. Thank you so much for your time. What's your take on the commentary coming in from Rajiv about the category breaker this particular CNG bike could become? And it's first of its kind. Clearly, you have full marks for that. The stock is higher by 2%. But what does it do to this category? This value category, 85, 95,000 per unit value category was ignored by everybody. All the players were focusing on premiumization. Can it revitalize that space and get volumes back?
Yeah, hi, good afternoon. Yeah, we have been seeing a K-shaped recovery all through, especially after the COVID, and that was reflected in the automobiles, in the two-wheelers as well. But at the same time, one of the most efficient companies is coming forward with the CNG kind of bikes. I think it's a welcome step, welcome move. It's a calculated move as well, and they have also showcased how they have changed things in the past. So I remain upbeat and positive about the changes. And yes, at the same time, there are increasingly green shoots being visible on the lower end of most of these consumer products as well. And this change is coming at the right time, possibly better growth ahead of us.
Right. The other area I would like your opinion on is large cap pharma. In fact, today, the second day when we are seeing even Laurus's of the world, the mid-tier ones coming back. But essentially, the move was started by large cap. There was an upgrade by Kotak on Lupin recently. But the gist is that the US generic market is reviving, pricing pressures are going on. But haven't the stocks already moved very well in the last 6 months? Would you be okay holding these stocks now if you have bought, or would you be tempted to book some profits, or there's long runway even from here? Large cap pharma.
In some pockets, there are, especially as you mentioned, in the US markets also, the generic prices are getting a little more steady. If you notice in the last 9 odd years, barring 1 or 2 years post-COVID, mostly the pharma sector was actually remaining quite subdued after a big run prior to that. So with the generic pharma prices in US stabilizing now, that's a big positive. At the same time, in some of the manufacturing setups, especially like CRAMS and CDMO spaces, especially India's capabilities are rising. At the same time, China plus one opportunity also ensures that the growth visibility continues to be good. So I would not say for the whole sector, but in pockets, some of these companies look quite good.
Alok, we've been talking about, in light of especially the defense minister's commentary as to what really the entire defense pack holds. I mean, it's for everyone to see the kind of move that you've seen, and parabolic at that, in the entire defense pack, and especially in select names like a Cochin Shipyard, Mazagon, etc. But for a long haul, and I would restrict it to the next 1 to 2 years, would you say that the best of the rally is behind us, or would you say it's good time as any to get into these names and still have significant headroom ahead of you?
No, especially when a sector is having a large structural upside in terms of growth, it's very difficult to call out a year or a very near-term move. But I must mention, with all credit to the government as well, by ensuring 75% of the total acquisition budget is now given to the domestic companies, tie-ups with nearly 40 companies, tie-ups with overseas OEMs as well. The last year, FY24, the defense exports were nearly $2.6 billion, up 32%. We haven't seen that. In the last 10 years, the total defense exports in India were 21 times of the prior 10 years. So the numbers are looking good. We must not look at the fact that defense expenditure is one of the largest expenditures in the budget for the government. Earlier, majority of this part was for operational expenses and imports. A large part in that is coming in the domestic side. The sector is just opening up. From the vantage point when I am seeing at, I do see maybe a decade plus of easy growth coming in there. We may see much more companies in the ancillary space also coming through. So we remain extremely bullish on the sector. Can't say what a very short-term move, but the long-term looks quite beautiful there.
Looks beautiful. Clearly, somebody was telling me, putting in perspective, that the amount of growth we've seen in the last 3-4 years, 50, 60, 70, 80%, but we are still importing more than 50% of our actual requirements. So that's the kind of, the stock market may have factored in a lot in certain cases. Look at Mazagon, 1 lakh crore MCAP. What are the under-owned areas, Alok, where you are now nibbling in our early studies?
So very interestingly, this market's pretty divided into two parts. And we saw a major sectoral leadership change happening, especially from the end of 2021. Prior to that, a lot of consumer-facing companies, the FMCGs, the ITs used to rule the roost. They were having cleanest of balance sheets in the prior decade and better ROEs, as well as maybe a 10-12% earnings growth, but that looked quite good compared to a 6% growth in the market. Things are turning around now. The other parts of the market, which were almost sleeping for 15 odd years, they have been rising. There's a reason they have been rising. We are seeing an increasingly higher concentration by the government on the same. They are serious about indigenization in various sectors. They are serious about making India programs, and we're seeing that capex leading the way, and the payment numbers also coming through. So some pockets, I would say that still in the power sector, in the real estate sector, and some of these domestic cyclicals, there are still a lot of people, a lot of areas which are still under-owned. I must highlight, say we spoke about defense, which is the largest, one of the largest expenditures for the government in the budget. It's not really there in any index. If you look at the largest, biggest employer in the country is Indian Railways, not really there in any of the sector, in any of the main indices. The largest outflow for a typical household in India is for their house, and real estate is hardly there in some of the major indices. Some of these sectors were really, really sleeping for 15 years, coming out of deep slumber. We do see long runway of growth in some of them. That's why they remain under-owned compared to the potential that they have, compared to the overall economic impact they have.
Look, stay with us. Lots more to talk about with you, but we're going to do that after this very quick commercial break. Right, back with closing trades right here on ET Now. Still under pressure for HDFC Bank. That's been a sort of no-go today. In fact, Alok wanted to talk about that with you, right? Because of the MSCI headroom, there were to be inflows of about $3 to $4 billion coming into HDFC Bank. And just one soft quarterly update, and we've knocked off, 7% nearly in just 2 trading sessions?
So, hi, although I can't really talk about a specific stock, but I must say that, there's one side which is the fundamental business strength of companies. And we have been seeing for certain companies, they have been kind of losing market share and the growth rates have got a little more subdued compared to the habit that we had all developed about certain companies that they would deliver high level of growth. MSCI inclusion kind of data, definitely it has a big impact, especially when the numbers are maybe 5-6 times of average delivery volume of the day of a stock. But on the long run, ultimately, it's the earnings and the growth that matters. And that's where I think we would try to place our bets on. So yes, this sector, especially in the banking sector, we have seen that the trinity of high credit growth, better margins, lower credit costs, that played out so beautifully well in the last 2-3 years. But can all three remain strong going forward? That's where some of our doubts are. Sometimes for the sake of growth, margins may get through. And maybe for the sake of margins, sometimes growth may get through. And then comes the higher yielding kind of area of personal loans, etc. So we do need to watch the space a little more carefully about the companies who can deliver profitable growth at a lower credit cost.
How are you positioned as far as some of these NBFCs are concerned, big or small? The data, the Q1 data has been coming out pretty mixed, not throwing up any clear trend. But the previous quarterly data showed that this is one space which is outgrowing the banks. Asset quality is still under check. Some of the valuations are also on the favoring side.
The way we would put it is, let's zoom out a bit. The last cycle and the previous decade was more of a consumption-driven growth in the country. And hence, a lot of value chain around consumption did pretty well, including the consumer lending. This cycle looks like is more predominantly driven by the capex-driven cycle. And there could be a very high chance that the capex lenders do pretty well. So some of those are coming in the form of NBFCs, which are more and more capex-oriented lenders, but also because the same thing did not work in the previous cycle. We have seen how a lot of wholesale lenders got converted into retail lenders. And we are now sitting on huge books, a lot more growth coming in at quite lower margins as well. Do they really price in the kind of credit costs that need to be priced in? That because of the higher supply needs to be seen. So within the NBFC space as well, our bet is more on the capex-oriented lenders rather than pure play retail financiers. Having said that, some of them are really marquee companies within the retail financing as well, where we still remain bullish.
Right, okay, that's the word coming in on some of those financials. ONGC holding out, Britannia holding out. There's, of course, Bajaj Auto, which is now at 9,700 thereabouts. SBI holding up a solid 2% as well. But just wanted to understand right now whether or not you have any sort of distinction within private banks and PSU banks. You were just talking about private banks, though. But does it really make sense to make any of these distinctions, or would you say just play the bottom-up stories?
So the distinction was pretty valid in the prior cycle, where the private banks were not only gaining market share, they were having higher growth, they were having better margins, and they were having lower credit cost. Everywhere they were beating PSU banks hands down. But having seen the worst of the times behind them, some of these PSU banks have actually come out quite winners in the way they have turned around their own businesses. We used to see the prior cycle was marked by a lot of capital raised by PSU banks, but those were almost like funding for existence. Now they come out with a capital raise that is more like funding for growth. And markets generally like somebody raising money for growth rather than just for existence purposes. We do think that not all of them, but few of these PSU banks have really turned the corner significantly. Their growth numbers are good. Some of them are having reasonably good margins, and the ROAs have also improved significantly. So yes, the gap between what the perception value of a PSU bank and private bank today is, that gap is much, much lesser than what it was maybe even 5-6 years ago.
Great to have you then on the show. Thank you so much for taking the time out and speaking with us today.
Thank you.
If you like this video, then like, share and subscribe to ET Now.